Live from the World Economic Forum this week in Davos, Switzerland. We are watching global markets. We're waiting on the European Central Bank to get a decision on interest rates from Mario Draghi. And, of course, we're looking at futures indicating a very strong open once again for the broader averages in the U.S. Joining me right now to talk markets and the economy is Guggenheim Partners Global Chief Investment Officer Scott Minerd. Scott, good to see you.
Great to see you, Maria.
Thank you so much. So the atmosphere is pretty bullish, and that has you
bullish.
A little worried.
Yeah, exactly. I mean, the guest who was just on was talking about his optimism about the economy. Clearly, the tax cuts are helping the economy a lot. People are re-rating stocks, believing that earnings will go up dramatically. There's every reason in the world to be optimistic, and that has me nervous.
Why? Why are you nervous about that?
Well, I've been to Davos before a number of times, and I remember being here 2 years ago, and oil prices were almost $25 a barrel at that point. Credit spreads had exploded, stocks were selling off, and everybody was saying we were going into a recession. And of course, if you'd bought then, it would have been a fantastic return. So I think the euphoria is getting the momentum of the market ahead of where it should be at this point. It's hard to argue that the market shouldn't be higher, but at the same time, markets don't move in straight lines, and it'd be maybe a time to think about changing your tack and lightening up a little bit on risk.
So how do you invest based on that sort of cautious skepticism?
Well, one of the things we've been doing has been moving into purchasing options. With volatility being so low, for instance, today, you can buy an at-the-money 1-year call option on the S&P 500 for 5%. If you believe that the Trump tax cut will lead to the increases in earnings that we expect, you probably have another 15 to 20% of upside in the market. So, it's a pretty low-cost way to capture the upside while not leaving yourself vulnerable to something that could be a shock.
You're talking about 15 to 20% from here. What, this year, next year? What,
during the course of the next year.
In the next year, 15 to 20%. That is good.
Well, it is. All you have to do is look at the effect of the tax cut and see how it impacts after-tax earnings. And we see S&P earnings probably around $1.60. Well, if you go back to the multiple that was on the market back in early November, when we really didn't think we were going to get tax reform, and you apply that same multiple to $1.60, you're another 15 to 20% up from here. Yeah,
I mean, I think the consensus was that earnings would be up in 18, about 11%, but then when you add the tax benefits, it's another 12%. So we're talking about 23% profit
Isn't
growth.
That amazing?
In 2018.
It's
that
incredible.
Is fantastic.
And honestly, I think people are not factoring in what the Commerce Secretary was talking about, which is these bonuses and the wage increases that are coming through the pipeline. I think it's going to add even more momentum.
How worried are you about this move in the dollar? I mean, the dollar now at a 3-year low. Obviously, Stephen Mnuchin making those comments yesterday. That's what every Treasury believes anyway. It's not like he told us anything that's a surprise. Right. I mean, everybody would always say we believe in a strong dollar, but they never did anything to actually show that they believe in a strong dollar.
Right. And I think the dollar will go where the dollar goes. But I think the key is to keep the confidence in the dollar as a store of value is very important in terms of having our capital flows. We need foreign capital.
Well, exactly. But what I'm saying is, I mean, if you're talking about 4% economic growth and you're talking about all this money coming to the U.S., you would think the dollar goes up.
Well, it's funny. You talk about that. In 2004 to 2006, while the Federal Reserve was raising rates and the stock market was going on to new highs, the dollar declined. And so it could be that part of the magic here to the economic expansion and earnings growth is the continued depreciation of the dollar. The key is not to let it turn into a slide. That's what occurred back in 1987. When the Federal Reserve was raising rates as the stock market went on to new highs, we were up like 30-odd% in October of 87, and the dollar started collapsing. And as the dollar collapsed, people lost confidence in the U.S. markets, and we suddenly had a stock market crash on our hands. Yeah. And I think that's the risk from the policy standpoint.
So when do you start worrying about higher wages, inflation, maybe the Fed blowing it with too many interest rate increases? You're expecting a 15 to 20% rally in stocks. That you said that's potential or possible in 18. So when do you start worrying about what throws us off of that track?
Well, look, I'm already worried.
Yeah.
So a lot of times things just come out of the blue. That's why I like the option strategy. But I'd like to see some more indication, like deterioration of breadth in the market. Some signs that that wage inflation is actually picking up. It's been really stagnant. But, we need to get wage inflation up to around 4% year over year before I would get really concerned. We're currently around 2.5%. But I'll tell you, 4% is coming.
It's coming, right?
It is coming.
This year.
By the end of this year.
A lot of people saying that, yeah. What about Europe? Interesting to see Europe doing well.
Yeah, well,
are you investing in Europe?
Yes, we have money allocated to Europe. We like Europe, but probably even more interesting, Maria, is the emerging markets. Places like Brazil, Chile. These places are really catching a very strong bid. And of course, if things are as good here as we expect them to be, and the dollar's weak, historically that's been the formula for emerging markets to do very, very well.
Well, you've got what, $300 billion
almost. I have to check.
To allocate. Are there industries that you think are poised to do better, and are you investing in other industries more so than others as a result of all of this? You've got to allocate all that capital.
Sure. Well, I mean, look, we really like insurance companies. One of the issues you face here is how quickly can your profits get competed away? When you get a tax cut like this, if you're McDonald's, for instance, you might actually consider lowering the price of your sandwiches to be more competitive against Arby's, right? Okay, but an insurance company priced their liabilities to their policyholders years ago, and they have their assets on their books, so the earnings are pretty insulated for the next 5 to 10 years. So I think there'll be a markup in those firms, a good markup for banks. The Bank of America looks very interesting. So that's the place where you see real value.
I think it's a great point that you make, because the regulatory environment and the rollback in regs has not hit the banks yet. I mean, there's an anticipation that it's going to hit them, but so far all we've seen are different people running agencies. No real rule changes yet, and that's coming because this rollback is real significant.
Well, it is, and especially if they have the ability to loosen up on lending a bit, and things that make no sense at all, like the restriction on repo, which I know is a fairly technical thing, but this is a relatively low-risk business, and they're at capacity because the soup of regulation we got out of the financial crisis is restricting them from investing in businesses that are pretty safe. The
reason that Donald Trump has rolled back lots of those regs. Scott, it's good to see you.
Good to see you too.
Thank you so much. Scott Minerd from Guggenheim joining us this morning.